Today we're going to go over a concept called counterparty risk and how it relates to the markets and GME and everything of the above. Justin is tired of ranting to people, so he's going to give them this guide.
Here's the thing. You've heard this phrase over and over and over again. You'll probably hear it over and over and over again, and this is trying to demystify it. So right here, I've got a triangle. This is the monetary pyramid. More on that in a second. The thing I want to note is that at the very top, you'll have the most secure asset, and then as you get further and further and further down, in a sense, you have more risk. But with the risk also comes the opportunity for increased reward. So the key is whenever you go from one part of the pyramid to the next layer, you cross these transition zones. And so I've got this green zone, this purple zone, and this blue zone right here. And counterparty risk generally arises when you cross one of these zones. Okay? So pretty simple so far. If we fill in the monetary pyramid, we would have gold or US treasuries at the very top. If you hold an ounce of gold in your hand, like a physical ounce, a gold coin or whatever in your hand, there is theoretically no counterparty risk for that. It's not a promise to give you a gold coin or whatever. The asset is the thing in of itself, and you can hold it, touch it, whatever. And so right here, we've got gold and US treasuries at the very, very top of the pyramid. The least risk is right there. One step down, you would have physical cash, and in America, that's the dollar issued by the Federal Reserve. So you've got the transition right here, and the counterparty risk, if you hold physical cash, is with the Fed. In other words, you would assume that the Fed would have, in theory, work with me here, the gold, silver, whatever, right, to redeem the physical cash for. And yes, I know that's no longer a thing, but just hypothetically, that would be the case. And then going from the physical cash to this purple level right here, that would be like putting your cash in the bank. When you put, your $100 into Bank of America, Wells Fargo, whatever, you say that, well, I have $100 cash in the bank, and that's kind of true, that's kind of not true. Because what you actually have is you have a $100 IOU from Bank of America, from Wells, or whatever, right? So in this particular case, from your perspective, when you put your cash into the bank, your counterparty is the bank itself. And the risk you have is that the bank might go bust. If the bank goes bust, you might not get your cash back in that regard. Now, in the States, we have FDIC for the banks, and we have NCUA for the credit unions. And this is designed specifically to ameliorate any concerns about counterparty risk. Sure, the bank may go bust, but if the bank does go bust, FDIC will step in and make you whole. Or at least that's what the belief is. And then if you go one level down on that, you might take your bank deposits and you might invest it in stocks, you might invest it in real estate, crypto, whatever, right? But the point is that you can even go further down into this blue level I have right here, where you will theoretically earn more yield for the money. But again, you have one more layer of risk. So let's say you buy a bunch of stock in some, I know ExxonMobil or whatever, right? Some large cap dividend paying company. Well, now you're assuming that, the company is not going to go bankrupt, the company mentions what going to happen to the company or anything like that. So that's kind of the counterparty risks there. So the key thing in this is that when you start at the top, you have the least risk, but you also have the least reward. The further down you go on the pyramid, the more yield or the more potential for yield you have, but also the more risk you introduce. And anytime you go through one of these transition phases right here, that's generally where you have a counterparty that's introduced into the equation. So, as I said before, when it comes to the stock side of things, the FDICs and the NCUAs in a very loose sense of the market are these DFMUs right here. So if you've seen the other videos, you've heard us talk about the Depository Trust Company, the Fixed Income Clearing Corporation, the OCC, the Options Clearing Corporation. And the key thing is that these guys are, again, the same thing where they were introduced, or I believe they were introduced to reduce the counterparty risk in the system. In other words, to guarantee that you are going to have your stock settled to you, you're going to have your options settled to you, or whatever, throughout the equation, or throughout the various transactions that you do, even if there's tremendous disruptions in the market. Last thing I wanted to call people's attention to, particularly from crypto land, is you have the same concepts playing out right here. So this is in the world of Bitcoin right here. Bitcoin would be the very base. So if you go back to right here, Bitcoin would be the very, actually holding, a Bitcoin in your own wallet would be the tippy top of the monetary pyramid for Bitcoin. Then you might have a second layer further down. Lightning would be the example here to transact much quicker, much cheaper. You buy your coffee with Lightning. You wouldn't necessarily buy your coffee with a Bitcoin. You could, but why would you? It's too slow. It's too expensive to send.
Same
So
thing with
anyway,
gold, though. I mean, if you want, you're
exactly,
not gonna buy
exactly.
a copy with gold. It's supposed to be that way because it's the most secure, therefore least transactable. This is kind of the way that these monetary pyramids are set up.
Exactly. And so that's again like, and the thing is like when you go further down in the level, it's like the way I would say it is like each like level that you go further down gets a superpower. And so physical cash, the superpower for physical cash is that it's fungible. You can easily move it around. You know, everyone kind of knows what it is. If you go further down to bank deposits, well, now you can turn your cash into digital money. You can spend it online. You can sell it to whoever. And if you go even further down, then you can, you know, maybe earn yield or whatever on it. So going down isn't necessarily a bad thing, but the point is that it introduced the concept of risk. And when you have fear that's introduced into the market, you'll have a flight up the monetary pyramid as people jump out of what they perceive to be more risky assets for safer assets. So for example, if you're in stocks, you might sell the stocks to put the cash back into a money market fund. If you're in a money market fund and you're concerned, you might have the money market fund put the funds into your bank. If you're concerned about your bank deposits, you might withdraw to physical cash. If you don't trust the cash, you might exchange your cash for gold, silver, whatever, Bitcoin, whatever on that front. So yeah, Josh, absolutely right. Just because you're going down on the layers doesn't necessarily mean it's worse or it's bad. It just means that the characteristic of the value changes for the good and for the bad, depending upon whatever you're trying to do.
Let's tie this back into the stock market and how it works. Let's say at the top you have these direct registered physical shares under your name. They are slow, hard to transact with, but you know that there's no counterparty risk there at the top of the bottle. Flight to safety. That's all it's used for. Then as we go down the list, you're going to say, okay, well, with my broker, maybe you use Robinhood. You have your shares in Robinhood, but yes, it's easier to transact, buy, sell, transact, but you have that introduces the next level of counterparty risk. Usually you don't actually have to worry about that because these guys never go bust. It's just when you're on a risk on environment, you want these high yielding instruments. Then as you go down, you'll go into these derivatives of the stock, which are getting more and more risky as you go down. It's just the way it goes.
Right. So talking about Robinhood is a good example of this. So I'm not necessarily calling out Robinhood and saying Robinhood did this, but just for example, let's say that your broker actually isn't buying the stock on your behalf. They're just giving you IOU of whatever stock that's going on. Why would a broker do this? Well, the broker just simply might assume you're retail, you're a bunch of dummies, you're going to lose everything. So as a broker, if I basically go short to your long positions, your loss will be my gain. So in other words, that the broker is going to capture your losses for their profit. Now, if something were to happen and suddenly, again, like I'll pick on GME because, you know, that's, you know, obviously this is where it all comes back from. If suddenly GME starts to run and then the broker is now short GME, they might lack the capital to go back into the markets to actually buy the shares of GME on your behalf, even though from your perspective, it looks like you have it looks like you have shares in your account. I mean, my go-to example to describe this is imagine you've got like a jar of Skittles. You can see how many Skittles you have in the jar. Some Skittles are blue, which are real shares. Some Skittles are red, which are IOU shares. You can see how many Skittles you have, but you're colorblind, so you can't see which one is which. And so that's kind of the analogy to go to. In computer shares, when you directly register your shares, what you're really doing is that you're pulling your shares up to theoretically the most secure position on the chain. There's no counterparty risk. It's not that Fidelity might owe you a share or Robinhood might owe you a share or IB or whatever. It's no. These shares are directly registered in your name. You're right there at the tippy top.
Basically, the main point that we're trying to get at here is the counterparty risk question. And this is not just happening in stocks, it's happening in banks too. If your bank goes bust, therefore you are liable if you are over the $250,000 guaranteed limit. But you have to be aware of who your counterparty is in every single situation because there is always risk unless you're at the top of that pyramid. And even then, there's still risk. If you own gold, you have the risk of it being stolen or losing it. Yeah. With these shares, you could there's still ways where you could lose, but these are the most riskless assets that you can have. And when there are these risk-off environments, you have to kind of understand where this capital is going to flow to because it always goes up the pyramid.
Yeah, I guess you hit the nail on the head. It's like just understand that like sometimes it makes sense to have risk, and like you know, putting money in a bank, you know, that makes sense for a lot of things. But just kind of be like cognizant and be aware that there's always this notion of the counterparty, and you're going to probably hear this word come up a lot more in the future. And this is just kind of a quick little primer on how to think about it, how to conceptualize it.
Yes, thank you, everybody. Short video. We appreciate your patience.